Mark Halpern is a certified financial planner, trust and estate practitioner, master financial advisor, philanthropist, who has helped business owners, entrepreneurs, professionals, and affluent families for 30 years. As CEO of wealthinsurance.com, Mark and his team provide tax advantage insurance solutions to protect families and their businesses, working closely with accountants, lawyers, bankers to provide comprehensive estate planning solutions for their clients. Widely known for his philanthropic activities, Mark is deeply engaged with community organizations, both Jewish and non-Jewish, ensuring that he can achieve his corporate goal to create $100 million of new philanthropy by annually working with clients, generous donors at nonprofits, and allied professionals in the field of law, accounting, insurance, finance, and investment management. Mark also teaches leadership and business ethics courses to professionals and university students at York, U of T, Ryerson, and Western. It is my pleasure to welcome Mark Halpern to share his knowledge about 10 year-end tax saving strategies. Thank you, Mark.
Thank you very much, Sharon, and thank you to Lisa Kotler for the invitation, and to everybody for being here tonight. I'm really excited. I want to wish everybody a Shana Tova, a good Gebench year for everyone. You know, we're at this period of time between Rosh Hashanah and Yom Kippur. They call it the 10 days of repentance, the Aseret Shebei Teshuvah. And they say there are 3 ways to ensure that you get a good writing in the book. One of them is certainly repenting, another is through prayer, and the other is through tzedakah. So talk about a good time. We're going to be talking about tzedakah tonight and charity. And if we can learn something about how to give charity in the most cost and tax effective way and make the biggest impact, often just by converting taxes into charity, I'm sure everybody would be very much interested in that. So I'm very excited by that. The last few years have been tough for a lot of people. You know, thank God it feels like we're out of that cloud. But at the same time, it made all of us much more aware of our mortality and also around our incompletions, people who didn't have planning in place, a will, powers of attorney, you know, people who haven't necessarily created a legacy for themselves. So I think tonight is a great opportunity because, you know, CHW Hadassah-WIZO is an amazing organization. And I can tell you I grew up in it. Why? I'm from Ottawa originally, but came to Toronto in the 60s. And my late mother of blessed memory, she was very much involved with Hadassah. And I remember as a teenager going to the Hadassah Bazaar. It was a big highlight for us to go there and just, you know, be seen and see, and it was great. So it's amazing that they're still kicking around and led by Sharon doing your legacy thing nationally. I'm very excited to share with you tonight some great ideas and sort of strategies that we use with other charities to hopefully inspire you all to put some good planning into place. So I'm just going to put up my PowerPoint, and I hope that everybody can see that, correct? Yes. So I'm going to put it on PowerPoint mode. And so far, so good? Great. Okay, great. So a lot's happened. Let's face it. You know, interest rates are up, inflation is up. You know, people have mortgages that are coming up for renewal. It's pretty crazy. So the government is very aware of all the challenges that we have. So apparently they're going to be introducing in the future a new 1-page simplified tax form with only 1 question on it. How much money did you make? Send it to us. Now, we joke around, and that seems like it's true. It's, you know, it's not what you make, it's what you keep, you know, but there's a big reality today. And what I want to do before I get to the 10 steps, which are really key to what we're talking about, I want to give you the runway in terms of how we get to those 10 steps or those 10 strategies that I think are very important for you and your families. First of all, taxes are going up. That's not a question of if, it's a question of when. We could see an increase in the capital gains rates. There could be a tax on inheritance, on wealth. It could be a tax on principal residences when you sell them. The government has to come up with money because they keep printing it. So, that's going to see an increase in taxes. To compound that, most Canadians have done little to no planning whatsoever. I meet people who are extremely wealthy, who don't have wills, don't have powers of attorney, don't have structures in place, haven't crystallized their tax liabilities or figured out how to pay it. So that's a challenge that we have to ask ourselves. There's also a risk to charities. The reason that CHW has me on this program and Sharon heading up the legacy side is if we're not talking to our donors about creating something in their estate towards a legacy gift, then what happens is it's like having a business where you have all of your revenue coming from one client. You wouldn't sleep at night worrying about what would happen if that client went bye-bye. It's the same thing with charity donors. There has to be some sort of gift in their will or some sort of blended gift, which we can speak about at another time. There's also the legacy risk for everybody who's listening. Most of us give money to, conquer cancer by riding their bike to Barrie or skipping rope championships or running in Miami half marathons. But there's really not anything built into people's estate plan around legacy. They give amounts, sort of sporadically, but it has to really be part of your estate plan. And the good news is with post-COVID, people are seeking more meaning in their life. They would like to go from what we call success to significance. Certainly the younger generation in particular really wants to make a difference. And so our corporate mission is threefold. We're trying to transform Canadian philanthropy by inspiring and educating professional advisors, charities, and donors to incorporate strategic philanthropy into estate planning to preserve wealth to leave a legacy. That's number one. The second part of our mission is we are specialists in tax-exempt insurance. And in Canada, most people know what insurance is. They just don't really know what it does. So we want to educate people, and that's what we're going to do tonight as well. And finally, Sharon mentioned about our $100 million goal. We have a much more audacious goal, which is to create a national community of 100 professionals and charities that if we're all creating $10 million a year and you've got 100 of those, that's $1 billion a year of charity. And that's not like sort of pie in the sky. It's almost like crowdfunding. So we're very excited about that ambitious plan. Now, if you've ever heard of somebody named Simon Sinek is probably one of the most well-watched TED Talks on finding your why. And I think in order to be successful, as CHW has been all these years, it's why are we here? So my why is the word tzedakah, which is often mistranslated as charity. Tzedakah actually means justice or righteousness. We have an ethical and moral obligation to give back, to show that we've been blessed, and all of us have. And if we can do it in a tax effective way, why not? Over the last 2 years, we've created $120 million of charity. And if you haven't had a chance, I did a TED Talk at Moses Neimer's Idea City back in 2019 called The New Philanthropy. If you get a chance, I suggest you watch it because it would really help frame what we're speaking about. Now, I started in this profession in 1991, but my real start was in 1974. And that's when my father of blessed memory died of a massive heart attack at the age of 50. I was 11. I was the youngest of 4 boys. And my mother, who was 48 at the time, had to go back to work to support our family. My father was a busy engineer, and unfortunately, there was no will, very little savings, and no life insurance. So it was hard for us, but we developed quite a big struggle muscle. Fast forward, I worked with some of Canada's most successful business owners and affluent families, and you'd think they'd have everything all together and organized. But I'm going to suggest 85% of the time it's not true. They're so busy looking after everything and everyone else that they don't have some basic planning in place. So we help people in 3 ways. One is estate planning, just making sure that your financial architecture and the financial furniture you have actually lines up with today's reality. That would be like wills and powers of attorney, etc. Then we also also involved with tax mitigation strategies, where we specialize in this insurance, as you'll see, that we'll talk about for charity. And then lastly, we're involved with philanthropy, helping clients create legacies for future generations, often just by turning taxes into charity. Now, I wish people just called me and said, Mark, I'd like to give away $5 million to charity or $1 million to charity. Most of the time, it has to come out of a comprehensive planning model. And hopefully everybody who's on this call is looking at these things in their entirety with your own planning. And what we do is we always end up talking about charitable plan giving at the end. And we explain that charity, if properly done, you can be remembered for giving a lot of money to charity as opposed to writing a big check to the government. Now, a lot of people will say, well, my kids, my grandkids, I got to take care of them, right? So that pushes them back. And it's true. Charity begins at home. But giving money to charity like CHW is not about disinheriting your kids. It's about adopting CHW and disinheriting the tax department. Do you hear that? Your kids are going to get exactly what they were supposed to, but you're going to be able to create something good for a cause that you care about. And for most of us, if they haven't done any planning, what happens is they've accumulated a lot of assets, a lot of wealth, and at some point they start accessing that money. But for our clients, most of the people we meet, we realize that when they die, likely they're going to have more money when they die than what they have today, which means that they're the custodian or trustee for the next generation. But what they're not aware of is that they're partnering with the tax department on that money. So it's really important that everybody do a financial plan to say, here, this is my tax bill today. If something were to happen, here are all these assumptions about buying kids' houses or travel or buying a cottage, etc. And here's what my tax bill is at the end of my life. What you'll do is you're going to find that you have what we call never spend money that you're never going to spend, but you're paying taxes on. Can we use some of that never spend money to preserve your estate for your family in its entirety, or to include charity in it, or both? And it's really important that everybody goes through that exercise, because we have taxes in Canada. Here's just a basket of stuff that any growth in these things, when you sell it, or when you die and you don't have a spouse, or the second to die of a husband and wife, there's a tax bill that will happen at that time. And in Ontario, here are the rates. If you have an RSP or RIF or pensions, and you, after a second to die of a husband and wife, or if you're single or widowed or divorced, upon death, the government's going to take 53.53% of that. It means if you have $1 million, it means it's only worth $470,000. Just put it in perspective. Capital gains, if you have any public non-registered stock, or ETFs, or mutual funds, or segregated funds that have appreciated, or if you have investment real estate, meaning not your house, a condo that you own for investment purposes, or a cottage, or you have a business, the government's going to want 27% of all those gains when you sell it or when you die. And if you have money in a corporation, like an investment company, a holding company, you could potentially have a double tax, and your taxes could be upwards of 70% without any proper planning. So it's really important that people see that, their money that they've got really is not worth the same amount that they think it is. I had met recently with an 80-year-old woman, a widowed woman, who's still a professional working, and she'd built up a $10 million net worth. And she was very big into stock. She did her own stock investing, and she built up her RSP and RIF, and she was feeling very proud of herself until I told her, I said, Sandra, you're not worth $10 million. You're only worth $6.5 million because of all the tax. Anyway, I won't tell you the words that she said to me. It really wasn't appropriate for an 80-year-old woman to be saying these things. But the good news is it got her attention. And with proper planning, we were able to preserve all that money for family and include charity as well. So when it comes down to it, all of us have three possible beneficiaries to our estate. You have family, you've got charity, and you've got the government. And each of us can only pick two. Which two would you pick? Most people would say family and charity. With proper planning, you can arrange things that you're remembered for giving a big check to charity, as opposed to writing a big check to Justin Trudeau. So taxes are important. Let's face it. They're kind of like the cartilage on the bone. They grease the wheel, and you have to pay taxes. But here's a great quote that says there's no law that says that you got to leave a tip. And since 1995, the government's introduced 25 different pieces of legislation to make it more favorable for Canadians to give money to charity because they know that they can't finance all that social welfare out there. We, as a country, we probably have some of the best opportunities than any other country, including the United States, to actually give money to charity and to have a benefit. So how do we do it? We create something what we call accidental philanthropists. There are two types of people that we met in life. There are some people who are just givers. That's part of their DNA. It came through their shul, their church, their mosque, wherever. They have that gene. And then there are those people who just didn't. They didn't have that education. When those people realize they have a choice where their taxes go, they can give them to charity. Suddenly they become accidental philanthropists. And the people who are already giving, like the people on this webinar, can now give more for the same cost or give the same amount at less cost. So here are some accidental philanthropists that you might know, or you might be one yourself. And it's just things that you should be considering, because these are people who can do extremely good things in a very cost and tax effective way. At the top of the list are widows, divorcees, and singles. They're one incident away from a huge tax disposition. They should know about it so they can make some choices now while the sun is shining. Anybody who's sold a business or some investment real estate or stock, that year that you sell, you have your biggest payday. You also have your biggest tax day. And that's the year that you can be your most charitable to mitigate those taxes. And we have ways to get those donations back to your family as well. Anybody who's done or will be doing an estate freeze, or as we see, if you have a tax bill that's going to be due next April 2024 on your 2023 taxes, and you're sitting there with some appreciated security stock that's grown, that's not even, you don't actually own all of it because whatever the growth is, 27% of it, it doesn't belong to you. Consider donating it now, or parking it in a donor advised fund perhaps this year before December 31st, and using that tax donation receipt to mitigate your taxes, because you'll see that when you donate stock, you don't pay any capital gains taxes if you donate the stock in kind, as we'll see. So anybody on this call who's right now giving CHW cash, checks, or credit cards, stop doing that. I know Lisa won't get upset with me, but start looking for your best performing stocks that have big pregnant capital gains and donate those in kind as well, because you'll get a receipt. You won't pay any capital gains taxes, and you'll be making a great gift in a very cost-effective way. And as we'll see, anyone who has an existing life insurance policy they no longer need, or there's going to be estate taxes on death, or you've already left a gift of a question in your will, certainly you should be doing that for CHW. These are all people that can leverage their gifts even more. And before we go into our 10 strategies, here's a very important did you know. First of all, life insurance can be owned and paid for by a charity, a private foundation, or a donor advised fund. That means CHW, Hadassah-WIZO, can actually be the owner of a life insurance policy. You can pay premiums for that policy to CHW and get a charitable receipt for those premiums that you're paying. And CHW is the beneficiary of that. It's amazing. You got to know about these things. Also, in any given year, charitable donations can be used to reduce annually 75% of your net taxable income. 75% of your net taxable income can be reduced by giving charity, and any amounts over 75%, or any that you don't use, can actually be carried forward for up to 5 years. So it makes sense to speak to your accountant or speak to your professional advisor to say, how can we balance this out or make it very economical for our family? The thing that most people are not aware of is that in the year of death, charitable donations can be used to mitigate 100% of terminal estate taxes, including those receipts can be used for the previous year, the year before death. That means if somebody owes, just as an example, $100,000 of tax on death, and they leave $200,000 to CHW or to a charity, the estate will get $100,000 or $200,000 charitable receipt, and now the $100,000 of tax doesn't go to Ottawa; it's become charity. So it's something to really consider building into your estate planning. And then the last thing, which was advertised on this event, is there are some new rules that are going to be introduced as of January 2024 called the alternative minimum tax. This is something that's been around for many, many years. And what it was a tax treatment underneath our regular tax regime that would basically recognize there were a lot of people out there who were getting non-traditional taxable earnings. It could be through capital gains, or it could be through dividends, or it could be through stock options, or through charitable giving. And what would happen is it was just a way for those people to pay their fair share of tax. So the government realizes that, it only applied to about 35,000 Canadians. So that's not a lot, but the rules have been expanded, and there are going to be a lot more people who are going to be affected by that. And it will impact some of the efficiency of what we're talking about, particularly when it comes to donating appreciated stock. Now there's possibly going to be a tax of or at least 30% of those gains will now be taxable, and capital gains will be now have 100% inclusion as opposed to 80% before. So I'm just recommending that people speak to their professional advisor. It really only applies to people making, let's say, $300,000 a year plus. Okay. And especially if they're getting it through, things like dividends or capital gains or something. So there are things you could plan in 2023 before the end of the year in order to make sure you get full benefit, as opposed to waiting till 2024 when you could lose some of those benefits. So, and if anybody wants any information on that, I can always give something to Lisa and to the team here, and they can make it available to anybody who's on this call. You can just send me an email. So let's get to our 10 end of year tax saving charitable strategies. And we'll go through these. We're good for time. So at minimum, although it's not the most tax efficient, between now and December 31st, make sure that you donate money. And the best way to do it is by giving cash, checks, or credit cards to charity. But if you do that, remember, you'll get a receipt, and you can use that receipt to mitigate up to 75% of your net taxes your net taxable income. But as I said, cash, checks, and credit cards are the least effective way to do it. So every one of us, every client I meet, has some ETFs or mutual funds or stock or segregated funds that they've accumulated. And what this means is that if you have, let's say, a stock that you paid $100,000 for, and now it's worth $200,000. So there's been $100,000 capital gain. If you sold that stock, you would have $100,000 capital gain, and $27,000 of that you'd have to pay to the government. So your $200,000 is not worth $200,000. It's worth $200,000 minus $27,000. Got it? But if you donate, that appreciated stock, or some of that appreciated stock, to CHW, you pay no capital gains at all. And you get a charitable receipt for the full market value, which now will help you reduce your taxes today. And you can do that on a personal basis, meaning if you own those stocks personally, or it's even better if you own those securities on a corporate basis. Let's just say, again, you had that same scenario. You had $100,000 of money and stocks that you had owned inside of your investment company, your holding company, and it's grown to $200,000. Again, if you were to sell those, there would be $100,000 capital gain. But if you donate those stocks in kind, you can use that charitable receipt to mitigate up to 75% of your net corporate taxes payable, and you don't pay any capital gains taxes. The icing on the cake, though, is the gain, which was $100,000 in that case, can now get credited to something called the capital dividend account, which is a notional account. And now $100,000 can be taken out of your corporation tax-free. If you would have taken that $100,000 out, you would have paid about 50% tax on it. And now you're able to get the whole $100,000 of those gains out completely tax-free. The other advantage of doing it corporately is it reduces the taxable value of your company. So start becoming a a hunter and gatherer. Look at your assets, look at your things, and figure out, are the things that you could be doing today to save taxes and create charity for causes that you care about and be able to do some good things for your family, right? So that's number two. If there are any questions on that, we can go through it. Number three, tax loss selling. So just as I mentioned about selling appreciated securities, when you get to the end of the year, there are people who actually will go ahead and sell the things that have the least best performing results in their portfolio. So let's say, somebody bought cryptocurrency, right? Or something that really tanked over the last few years, and you have a loss. You're like, I'm waiting for that loss to get better so that I can actually make it into money. Sometimes it's really a good idea to sell your loss. Why? Because whatever you sell it for at that loss, you can actually carry back that loss for up to 3 years to offset your capital gains that you had over the last 3 years. So in fact, you can actually use those losses to carry back against any capital gains over the last 3 years. That means your tax return can actually now find you money. So that's a good thing. The other thing is you don't necessarily have to use that loss at that moment. You can use the loss, but not actually apply it. And losses can be carried forward indefinitely, forever and ever, which means that if you hold on to those losses in a year that you have a lot of gains, you can use those losses to offset those gains so that you can actually get your money out that you actually have appreciated, hopefully without any tax, by utilizing those losses. Do you hear? So that's something that people do. It's harvesting at the end of the year, looking through your book and having somebody help to guide you, be the Sherpa to sort of find where are the ways that you can be doing the best for yourself and for your family. Number 4, the use of flow-through shares. So, if somebody wanted to give cash, it works out to about 50 cents per dollar that you give if you're giving cash to charity. And let's say they wanted to give stock that we said before, right? Appreciated stock. That works out to, assuming you have a low cost stock that didn't cost you a lot of money. So that works out to about 23 cents on the dollar. So flow-through shares, when they're available, they're actually they're involved with exploration, mining, etc., and they allow you, depending on what province you're in and what structure is put into place, for you to be able to give charity at a cost of somewhere between 5 to 15 cents per dollar, which means that it's a very powerful way. If you're already giving, it's just a way of you giving at a much lower cost than giving cash. Now, there are companies out there like Bear Tove, WSPD out of Ottawa, Oberon, Sprott, Pear Tree. These are different flow-through companies. And when they have inventory, it's good to know about it so that you can sort of push the button at this time of year or when it's available in order to be able to get your charity dollars for the least cost. And you can speak to Lisa Colt. I know she does this. There are, they can educate you, or you can reach out to us and we can put you in touch with people that can certainly help you understand it. I suggest that you get the education now and know how it works, so that when these flow-throughs are available, which, they sort of go pretty quickly, you'll be in a position not to have to have the education so much. You'll actually be in the position to execute on it, to be able to save a whole bunch of taxes and be able to give money to charity. That's number 4. Number 5. Most people know about what it is to set up a private foundation. A private foundation, there's some setup costs, there's annual reporting, and you really should have at least $1 million in this private foundation or more in order to make it sort of work most efficiently. And you're also the type of person that likes to manage your own charitable dollars as far as investing, etc. So not everybody's in that situation, but you could actually have a similar private foundation for yourself, but instead what it's called is a donor advised fund, or a DAF. What that is you borrow or you piggyback a community foundation. It could be the Jewish Foundation, there's the Toronto Foundation, the Barrie Foundation, there's Abundance, there's Benefaction, there's Canada Gives. There are all these different umbrellas, and then you put your own named foundation underneath that umbrella. And what happens is that will be like your family's charitable bank account. Whatever you put into it, cash or shares or insurance, you're going to get one charitable receipt. So you don't have to go around every year collecting from everybody. You'll get one charitable receipt, and that money now is charity. And you can now distribute that money in denominations as low as $100 to any registered charity in Canada. And there are 86,000 charities. Ideally, you're going to have a bunch of it go to CHW, Hadassah-WIZO. But the point is that you have your own foundation, and it's lovely because you and your spouse or your children, like we have 4 of them, or grandkids, can actually be on the board of that little private foundation, that donor advised fund. So if God forbid me and my wife went bye-bye, they could step in, and now they can continue to distribute money in perpetuity to the causes that were important to us or that would be important to them. So I really highly recommend reach out. I'm actually doing on Friday, I'm doing a Philanthropy Friday LinkedIn event from 12 to 1, and it's all about donor advised funds. And my guest is going to be a gal by the name of Denise Castengay, who's the CEO of Canada Gives. And we're going to be speaking very specifically about donor advised funds. So check it out. You can find out on LinkedIn, go to my profile, and you can actually register and be there. So that's donor advised funds. And that would be the place if when you sell stock or you donate it in kind, if you're not ready to give it to that specific charity right away, so you put it into your donor advised fund, and it's kind of like a parking lot. You don't have to give away the money right away. It's sitting there, and you can now work out how you're going to distribute that money going forward. Number 6, CPP philanthropy, Canada Pension Plan. When you're 65 in Canada, you can start receiving CPP. And for a husband and wife, it works out to about $26,000 a year. And most people, they don't really need it. They get it, it's taxed, they reinvest it, it's taxed again. And they also have to realize that when they die, the CPP ends as well. So if they are philanthropic and they want to do something good with that CPP, that couple could take that $26,000 and they could acquire a $1.5 million life insurance policy with that. If it's owned by CHW, then your CPP is considered a charitable donation. So you pay no taxes on your CPP at all, but you've created a $1.5 million gift for the charity that you care about. Alternatively, you could take your CPP, get the $1.5 million policy, but don't have it owned by charity, have the beneficiary on death be charity. So charity would get $1.5 million, which would save your estate $750,000 of taxes just by using CPP. A third way would be get the CPP, get the $1.5 million policy, and make your children the beneficiary of that, and instead donate your RSPs or RIFs upon death to charity, which would have been taxed at 53.53%. Now your kids have $1.5 million, and your charity has the full amount of your RSP or RIF, and the government gets nothing. The last thing, which I love with CPP, I call this the grandparent pension plan. And that is take the $26,000, get the $1.5 million policy, and make your grandchildren be the beneficiary of that policy. Now there'll be $1.5 million that could be invested at, let's say, 5%. It'll generate $75,000 a year in perpetuity forever. And you can have them use that money for whatever they want, or have them use that money to give to charity themselves to save taxes when they're older. But again, all by using CPP, something that most people don't give any attention to. So think of that. That's number 6. Number 7, a lot of us have RSPs or RIFs. As a matter of fact, Canadians have a lot of money in registered money. And if you're a wealthier person, you don't necessarily need the income, but you must start taking the income out at age 71. And upon death, as I said, all of it's going to be taxed at 53.53%. So one of the things you might want to consider is when you start taking that income, and now it's a taxable income, why not just donate that income to charity, like to CHW? Now you won't pay any taxes on your RIF income, but you're figuring out a nice way to give to CHW with money that you would have just been paying taxes on. Alternatively, while you're alive, you could donate some or all of your registered money to charity today. And people don't realize this. If it's not going to move the dial on your lifestyle expense or your estate needs or money you're giving to your kids, why not give away some or all of your registered money today? And the way that you do that is you can actually take the money, some or all of it, give it to charity. We can actually get the 30% withholding tax removed because there's a government form that allows that. But now the money will be taxed at 53.5%, but you'll get a charitable receipt for 50%. So now your RIF only loses 3.5%, and you've created a whole bunch of money for charity at a cost of 3.5% versus having 53.5% dialed down from that money for your family. So again, it's finding opportunities just amongst the assets that you currently have in your portfolio. So that's number 7. Number 8, a lot of us have old life insurance policies. We may have gotten them when the kids were young. We had a mortgage. You had to put food on the table, an education fund, or perhaps you use that policy for a business partnership or whatever. But there are these policies that we have that maybe won't move the dial on our family's estate planning. Well, you can actually take that policy today and donate it to CHW and get a charitable receipt for the fair market value of that policy. And now going forward, the premiums you pay will be charitable donations, but you've created a beautiful gift for CHW with something that you already have. So let me give you an example. We just did a policy. It was a $300,000 permanent insurance policy that somebody had. They'd become uninsurable. So they were able to donate that policy to their university. They received a $187,000 fair market value donation receipt for that, because that would be the value, because he's older and his life expectancy is less. So that saves him over $90,000 of tax. And going forward, the premiums he pays are charitable donations. But in this case, the charity actually paid the premiums going forward. They have donors who will make donations to the charity and use that money to fund these policies. So what will happen in the end, this person takes a $300,000 policy that they weren't paying a lot of attention to. It helped them save $90,000 of tax, and they created a $300,000 gift. And the charity recognizes the donor, and they recognize the person who's funding that on behalf of the charity. So look around. You might have something that will help you save a lot of taxes and create a lot of good. The other thing when it comes to insurance is if you have a term life insurance policy, which a lot of people have, that's sort of a policy that goes up in cost every 10 or 20 years, and it starts to become pretty cost prohibitive. Most people will cancel that because it's too expensive. But there's an opportunity to convert some or all of that term insurance into a permanent life insurance policy without any medical evidence. So if you're older and perhaps you have some health challenges, that policy could be extremely valuable. So you can actually convert that policy, donate it to charity, where the charity will actually often pay the premiums going forward because of the nice ROI, the return on investment on that ultimate death benefit that's going to be paid out. We just did this with a hospital foundation where an individual had a $2 million policy that they were going to cancel. They didn't need. And instead, they converted that policy, and they were uninsurable. They had Parkinson's, and they donated that $2 million policy to the hospital foundation. They received a $1.3 million charitable receipt for that, which saves them $650,000 of tax. And now the charity is paying for the premiums going forward, because to get a $2 million payout on somebody whose life expectancy is shortened is a very good investment for them. So don't let your term insurance policies just get canceled or lapse. Look at opportunities to save taxes and turn them into gifts. And then the last thing I want to talk about is that in March of this year, Canada Life became the first insurance company in Canada to actually introduce a charitable life insurance policy. And what's the advantage of it? It's only one premium only that if you donate this amount, the minimum is $10,000, but you donate an amount, let's say to CHW Hadassah-WIZO, your net cost, right, is half of whatever the premium was, but the benefit to the charity is anywhere between 5 to 20 times larger than the net cost to you. So that's lovely in terms of creating a legacy gift. But as we'll see, they actually have a bigger advantage in that most people think that with life insurance, the charity will only benefit when you die. But with this policy, it produces every year something called a dividend. And one of those dividend options is to take it as cash. If it's owned by CHW Hadassah-WIZO, then Hadassah-WIZO can get a dividend every single year that you're alive to help them use it for whatever they want it to go to. And there's still a legacy gift at the back end. So I'm going to illustrate this now. This is the one premium only legacy policy from Canada Life. And as you can see here, these are the ages 45, 55, 65, and 75. And it's one premium only. It actually starts as a $30,000 death benefit, but it increases. So as you can see, a 45-year-old can get an insurance policy at a cost of $18,750 one time. That's a charitable donation. That means their net cost is only $93.75. And at age 90, CHW Hadassah-WIZO will have a gift of $140,000, all at a cost of $93.75 for the donor. This could be further enhanced. Instead of using $18,750 in cash, use $18,750 of stock that's appreciated. That would make this even more impactful for you. But as you can see, age 55, age 65, and 75, the costs go up because the ages are different. And because of that, the benefit at age 90 is a little bit is less. But a 55-year-old for a net cost of $11,000 can create a $100,000 gift. 65, 13,000 creates a gift of 70,500. Now, I want everyone to realize that this is based on just a female single life who's healthy and non-smoker. You could do the exact same policy on what's known as a joint last to die basis, meaning on a husband and wife. So it's a policy on two of them that pays out on the second to die. If that's the case, these numbers are off. The benefit would actually probably be around 40% more than what I'm illustrating. So there's no cookie cutter here. It's something that each person should take a look at. Now, if you don't want to sort of put that kind of a number in, well, we have the legacy circle. And this would be instead paying premiums every year of your life to be part of the life legacy circle. And I've given examples here of a $30,000 policy, a $50,000 policy, and a $100,000 policy. I've just put in here age 65 and 75, but it shows you that at a net cost for a $30,000 policy, it's only $583 a year. For a $100,000 policy, it's $1,379 a year. That's the net cost. And age 75, obviously, it goes up. And this is also based on just a single female. If you did this on a joint policy on a husband and wife, you could see a delta change here of up to 40%. The point here is that you could do this with cash or you could do it with shares. But what you are doing is, ideally what CHW Hadassah-WIZO wants is to have a portfolio of policies that eventually after the next, after 120 years, they're going to have a portfolio of money that could actually now be invested later on in the future to create annual cash flow for the organization so that fundraisers don't have to wake up on January 1st looking around for how do we have money to sustain and build on all the great programs we're doing. Here we've got a bank for the future that's actually going to create something. And Hadassah, of course, will recognize you for this. And they'll also recognize you if you leave a gift in your will. Just let somebody know. They want to be able to recognize you while you're alive for your generosity. And some people would really like that. It's great for families and it's great for your children and even more so for your grandchildren. That's kind of on the life insurance side. If we have any questions, you can always reach out to me and I'm happy to discuss this. I just want to wrap up and ask people on this call. Most of us know the names of our grandparents, correct? Sharon, you know the names of your grandparents, but how many of us know the names of our great-grandparents? Most people don't know the names of their great-grandparents. These are actually my great-grandparents, and I have pictures of several of my great-grandparents. This is Aaron and Liba Gross in 1934 in Poland before they were killed in the Holocaust. Imagine if on January the 1st, you received an envelope in the mail, and inside there was a check for $10,000 from your great-grandfather. You think you'd remember their name? So there are ways with planning that you can be remembered. They say you live once, but you die twice. I understand dying once, but dying twice, what is that all about? Dying the second time is when people stop talking about you. They stop mentioning your name, right? How many people know the names of their great-grandparents? So look, if they say that the apple doesn't fall far from the tree, that's when the weather conditions are perfect. But when the weather conditions are stormy, like they are in this crazy world we're living in, it's so chaotic, social media, all the changes, the apple doesn't even know it came from a tree. So there are two ways to pass along these values, these ethics to our children, and more importantly, to our grandchildren. And that's either through religion, our Jewish traditions, the Torah, keeping close to that, or through tzedakah, giving charity, or through both. And they're not, diametrically opposed. But what it really does require is people have to sit down and ask themselves, how do I want to be remembered? How could I make a difference? And Lisa and her team and Sharon, they want to help you to really be remembered, and they want to help you put your money towards good use to help perpetuate this wonderful organization going forward that is so near and dear to so many of us. Sharon, you mentioned 38 years. That's a couple of years, you want your kids, your grandchildren, people to be involved. Well, now's the time to do it. So what are the next steps? And then we'll wrap up. I have something called the 48-hour rule, which is if something here touched you, you got inspired, you got to do something about it within the next 48 hours. Otherwise, we go back to sleep, put on the snooze button, and we're on to the next thing. We're so busy. The other thing is connect with me on LinkedIn. I'm always posting about charitable stuff, and hopefully it'll keep you inspired. I also have a tax letter digest made up of about 160 articles, all on charity and the ideas we've been talking about. And we have one-pagers that are sort of a case study on all those things that we've talked about today. Please reach out to me. I'm happy to share that. Watch my TED Talk, The New Philanthropy. I think that's great. And that'll help frame what we're talking about. And as part of my relationship with Lisa and the group here, we want to offer people who are listening a no obligation consultation, meaning, if you would like, I'm happy to meet with you by Zoom or in person. We can look at your own estate planning and work with your existing advisors, bring them in to make sure that you're optimizing your situation. And there's no obligation, but it all helps to create this $1 billion that we're so excited about doing. And the last thing is consider your own legacy. We went through some of those ideas already. How do you want to be remembered? I'll just end with one story, and it's a true story. There was a fellow named Nick who heard me speak at one of these lectures. It was at one of the libraries. And Nick was quite a Renaissance man. He was a Holocaust survivor. He was in his late 70s, never was married, never kids. And he'd done very well for himself. As a matter of fact, he had a $3.5 million estate tax. And he was interested in seeing how he could do something for charity. So we went out and spoke to different charities. He was involved with physics and astrology and sciences. So we went out to match him with those types of things to get a proposal on what he could do. Anyway, Nick was always traveling and busy, and we couldn't move the dial along. And then I called him one day and he said, Mark, it's not a good time. He was at North York General. He said he had a heart attack and he would contact me when he gets out of the hospital. Anyway, the next Wednesday, I noticed in the obituaries in the Benjamins section that Nick had died and that the funeral was going to be on that Thursday. And I went to that funeral and there were very few people there. He'd been involved with some hobby groups, etc. But, I helped, me and the rabbi, we helped to sort of finish putting the earth back onto Nick's grave. And I just couldn't think how Nick never got around to doing that legacy gift. And instead, that $3.5 million is going to the government. And he could have done something so significant, something so worthwhile, if only he'd gotten around to it. So the one thing I really want to pass along is time is limited. The best time to do all of this is clearly while the sun is shining. And here's my contact information. If I can help anybody, please reach out. As I said, no obligation. We just want to do good. And I really want to thank everybody at CHW Hadassah-WIZO for inviting me. This has been, for me, I think my mother of blessed memory is getting lots of nachas. Here I am speaking to a group that she was involved with way back when, and gives me a lot of pleasure to be able to give back. So thank you very much. And I want to wish everybody they should have a good year and should have an easy and meaningful fast this Yom Kippur. Thank you very much for having me.
Thank you so much, Mark. It's a pleasure having you and a pleasure working with you. We've known each other a long time, and Mark is the expert in this space, which is why we keep inviting him to come back and share new ideas with us. So thank you for taking this time. I'm going to facilitate Q&A for a few minutes. We've got about 6 minutes left, so we can take some questions. The first question that has been posed is, do you have any information on the tax-free first home savings account?
Oh, thank you very much. It's a great idea that people don't know about. It was something that was brought up as an amendment for legislation back in November 2022, and it became law April 1st, 2023. Hear this. It was really developed to help people save money, especially young people save money to do a first-time home buyer if they've never bought, or it could be a condo. So what it is this: it's a hybrid between an RSP and a TFSA. So an individual can put in $8,000 a year or $40,000 maximum, and it can grow. And when they give $8,000, they get a RSP type receipt for that, which saves that young person $4,000 of taxes. But now that money grows tax-free. Between that and the fact that the government allows you to take money out of your RSP for a first-time home buyer, and with your TFSA, it actually allows a young person to be in a situation when they want to buy a house to have at least $250,000 available, right, between a husband and a wife. So what we recommend is this: bubbies, 80s, grandparents, you have grandchildren. If you give them $8,000 of cash, there's no attribution back to you. It's a gift to them. You can give cash to them. You give them that $8,000. Now they can get this first-time home savings account. They give the $8,000. That'll save them $4,000 of taxes, but now they'll have a fund that's going to continue to accumulate to be able to buy a house. And living in Toronto, I don't know how far $250,000 is going to go, certainly in like 10 years time for now. But if your kids are going to live in, outside of Toronto or somewhere in the States where you can go to Cleveland and buy a 4-bedroom house for $250,000, if you want to send your kids there, then it's something you can do. But if they don't use the money for the home buyers plan, then you can actually use that money and put it into your own RSP. So it's got a lot of great moving parts. Just look into it, speak to your financial advisor. We'd be happy to give you more information on that as well.
Great. Thanks, Mark. Next question. If someone wants to donate an RSP or a RIF, do you have to give all of it, or can you only give a portion of it to a charity?
That's a great question, Lisa. It's not all or nothing. You can give as little or as much as you like. So remember we talked about that, doing that financial plan. If you see that you have a check mark, you're not going to run out of money. Your living lifestyle expenses are looked after, and there's going to be money that you're never going to spend that's for the next generation. Well, that's the time to look at my RSP or RIF. I know at 71, I'm going to have to start pulling it out, and whatever I pull out is going to be considered pure income, and I'm going to be paying taxes on it. So why not do something with it today, and you can actually see the benefits of it and be able to help CHW, Hadassah-WIZO, or any other charity you care about by just using money that half of it doesn't belong to you. It belongs to the government. So why not just at a cost of 3.5%, use it today to do great things with and see the results of your largesse.
Okay, one more question. What type of money do you have to be a philanthropist? Do you have to be a millionaire or a billionaire? Or how can you really make an impact with not a lot of money?
It's a great question. Everybody always thinks that you have to be Bill Gates or Warren Buffett to be a philanthropist, but that's not true. I think the word philanthropy is a little too kind of snooty. It's kind of philanthropist. When you're talking about setting up a donor advised fund, that's where you actually have your own foundation getting in on the cheap. Like it's not even setting it up and putting $1 million. That would be a way. But certainly, we all, as we said, we have stock. We have mutual funds, we have ETFs, we have old life insurance policies. It really doesn't matter. And certainly in the case of CHW, Hadassah-WIZO, they really need money to keep the lights on. And for most organizations, they're always focused on just current dollars to pay their bills and fulfill their budget. And maybe every 3 to 5 years, they do a capital campaign, either for a special project or to catch up. But this whole area of legacy plan giving gets very little attention. And the reason is there are not a lot of people talking about it, but they're not able to talk about it in a very intelligent way to help donors. And we're also afraid that if we speak to a donor about a future gift, they might dial down the current gift for the benefit of the future gift. But I think it's really important. That's why we act as sort of like a legacy process consultant. You'll see that you can find money just from what you have currently or from taxes that you're paying to create these gifts. And obviously the best time to do that is now. And especially at the end of the year, especially if you're going to have taxes that are going to be due in April, now's the time to be doing that planning. So please reach out to us. We'd love to help you in any way we can.
Okay. If you can only do one major donation, which of the 10 strategies do you recommend?
Ooh. I love the donation of stock. I just think it's brilliant. Like, I was just with that woman that I mentioned, the 80-year-old woman. She had $5 million of stock. $5 million. She was a real good stock player, but it only cost her $1 million. That means she had $4 million of capital gains, which meant if she sold all of that or she died because she didn't have a husband, $1 million was going to the government. That means she's not really worth $5 million. She's only worth $4 million, whether she likes it or not. Why wouldn't you go ahead and take that money and use it today to help a charity and yourself? And if you want that $1 million back so badly that you gave to the charity, in order to alleviate those taxes, then why not then use life insurance for pennies on the dollar to buy an insurance policy that will replace the amount of money that you gave to charity? Now you're made completely whole. The charity gets a whole bunch of money. You saved a whole bunch of tax, and your family's going to get all the money back that you donated to charity through that life insurance policy. So I just think everyone's got stock or ETFs or mutual funds or seg funds in their portfolio. Look for your biggest, fattest, pregnant capital gains and donate it now while you can.
Okay, thank you, Mark. I just want to remind everyone that to join the Legacy Circle, you don't have to leave a minimum gift. You have to leave us a letter of intent. And obviously, the more that you decide to leave to charity, the more the organization benefits, the bigger tax receipt you're going to receive. We will recognize you, as Mark said, in your lifetime, and you will receive a fruit-bearing tree at one of our youth villages in your memory, a Legacy Circle pin, recognition in our donor magazine, or for in perpetuity, and we'll also, on the anniversary of your passing, say the Yortzeit prayer at the Abel Synagogue at Hadassah Medical Center, which is the synagogue surrounded by the beautiful Chagall windows. So there's information online on our website at chw.ca/legacy-circle. And I hope that you'll consider a gift to us. Mark is more than willing to answer questions. If you want me to help facilitate a meeting, I'd be happy to. And Mark, again, I just want to thank you so much for being here, for being so supportive of CHW. And I'm turning it over to Lynn for some final remarks.
Thank you very much. Hi, I'm Lynn Gilman, National President, and I hope that you have enjoyed tonight's webinar and increased your knowledge about legacy giving and the life-changing impact a gift can make for CHW. Over the past year, CHW implemented several significant changes to refresh our brand. Launch of a new website, increasing our profile in the community and attracting a new generation of donors. One of the recent changes was to enhance our Legacy Circle program, which includes more recognition and benefits for our generous donors. In fact, last year, during our inaugural Journey for Impact trip, we inaugurated the CHW Legacy Circle Garden, which commemorated 100 years at CHW Nahalal Youth Village and recognized Legacy Circle members who have passed on. Our Legacy Circle program ensures that a fruit-bearing tree will be planted in memory of donors who become a member of the Legacy Circle. As an organization with such a rich, long history, our mission is to empower women and children, and we'll never waver and continue to grow stronger. Everything we do, everything we have achieved, continues to propel us forward. Legacy giving ensures that CHW will support Israel and Canada for another 100 years, and with the impact on future generations. I hope that you will join me and many other dedicated and passionate CHW supporters who have been included in CHW, who have included CHW in their estate plans by making a commitment and signing a letter of intent that you have a planned gift for CHW. It is very easy to do. Please contact Lisa to discuss your interests, and she will work with you to help fulfill your philanthropic goals. Our heartfelt appreciation to Mark Halpern of wealthinsurance.com for his interesting and informative presentation, and of course, his continued support of CHW. Finally, thank you to all of you for joining us today.